Hey, welcome back everyone to the Real Money Pros. I'm Nic Daniels. Let's talk about market volatility. So far, 2025 has been, well, an exciting year if you like volatility in the stock markets. And if you were thinking about retiring this calendar year, that might have you nervous. How do you retire during years of market volatility? And I want to talk specifically about something that not a lot of people hit on, and that is called sequence of return risk. And that applies to what we're facing right now. So let's dive into that. Most people think that just the average rate of return on their investments is going to be the most important determining factor in how successful they could be in retirement. That's not really true. You have to consider sequence of return risk. And what does that mean? What order do you get that rate of return? Because remember, your average rate of return is what you've gotten year over year over year over year, and then divided by all of those years. But what happens if you have a really great year in the first 1, 2, 3 years of your retirement versus what we're experiencing in 2025, years of volatility early on in your retirement? Do those two differences have anything to do with your retirement success? They do, and that's called sequence of return risk. And let's look at two scenarios, two possible retirees with the same portfolio and the same average rate of return, but let's look at how sequence of return risk could impact their retirement, possibly by decades. All right, so let's take a look at how sequence of return risk can actually affect a portfolio. We're gonna compare two retirees. We've got retiree A with an invested net worth of $1 million. He's hoping to average a 7% rate of return over the next 5 years. He plans on withdrawing $50,000 a year to supplement his lifestyle in retirement. And retiree B, a same $1 million nest egg. He's hoping to average the same 7% over a 5-year time span. He's gonna withdraw the same $50,000 a year to supplement his retirement lifestyle. But let's compare how the sequence of returns could affect these two retirees and their portfolios. Retiree A, the first year of retirement, he sees a plus 20% return in the markets. That's amazing. After pulling out his $50,000, he still has $1.14 million in his retirement nest egg. Looking great. Retiree B, though, they experience a negative 20% return in the markets in that first year of retirement, and he's starting to sweat. He only has $760,000 in his nest egg. The next year, we see a positive 12% rate of return in the markets for retiree A. He's feeling good. He takes out his $50,000, and what is he left with? Now he's got $1.123 million. He's thinking, man, my retirement plan is dialed. Retiree B, in this a sequence of return, he gets negative 12% in year 2. He still takes out his $50,000 that he needs to supplement retirement, but his nest egg keeps taking a hit. He's now down to $668,800 in his nest egg, and he's continuing to sweat. Year 3, retiree A, they see another positive year in the markets. He gets 8% in the markets this year. He still has $1,262,688 in his retirement nest egg. Retiree B, in year 3, the markets are down 8%. He still has to take $50,000 a year in order to do what he's trying to do and live his ideal lifestyle in retirement. What does he have at the end of year 3? He's down to $562,896, and he's sweating even more. Now, all good things must come to an end, and in year 4, the markets aren't positive for retiree A. They see a 10% drop in the broad markets in year 4 of retiree A's retirement plan. Well, he's gonna continue taking $50,000 a year out because it's just meeting his living goals in retirement, but his nest egg drops a little bit. $1,086,400 $119. And he's looking at it saying, man, the markets were down 10%. I still have over $1 million in my nest egg. He's not happy with a 10% drop, but he's feeling confident in his plans. Now, in year 4, finally, retiree B is experiencing a good year in the markets. He sees a positive return of 10% in the broad stock markets in year 4 of retiree B's life. And he's like, it is about time. I didn't think the markets could continue to slide forever. So he's seeing positive returns. He's taken his $50,000 to keep meeting his lifestyle goals in retirement. Where's his nest egg jump up to? $563,186. So he's about stayed even. He's thinking, whoo. All right, so now we're coming up on year 5 of these 2 different scenarios of retirement. In year 5, retiree A, what happens in the stock markets? Down 15%. Ooh, that's a hit. He still needs his $50,000 out of the account. What's his nest egg down to? Well, now he is down for sure after a 15% decline. He's left with $857,456. So that's a pretty big hit, down 15%. But he's thinking markets aren't gonna stay down forever. I'm gonna stay the course. If I have another couple years of positive years and I'm only taking $50,000 a year out, I think it's sustainable. Now, let's take a look at retiree B. In year 5, the stock market is up 15%, and he's thinking, yes, I needed another year of positive returns because I was looking pretty low and I want to keep on taking $50,000 a year out. Well, in year 5, he's up to $597,000, 664 to be exact. So you can see how sequence of return, we know markets are going to be down, we just don't know when. Sequence of return, negative market years at the beginning of retirement versus positive market returns at the beginning of retirement can greatly affect your overall nest egg. So the question is, how can you mitigate sequence of return risk? All right, so we've seen how sequence of return risk can greatly impact your odds of success in retirement. So now the question is, how do you protect yourself from that? It's why we at the Real Money Pros really believe in what we call the bucket system or the bucket strategy. Bucket number 1 is where you have short-term cash reserves set aside because we don't know when a market downturn is going to occur. We just know that it will occur at some point. So if you're always sitting on some cash reserves that have you in a position ready to weather a market downturn storm, you're going to be okay. Next, we're looking at bucket 2, where you have income investments, say bonds or other income positions, where they're going to be less volatile. The ups and downs are not going to be as extreme during times of market volatility, and those assets are still going to be providing consistent income to you on an annual basis. And then finally, you're going to have a third bucket, the bucket 3 growth bucket, where you still have assets set aside for long-term growth. It's going to help you fight inflation. Yes, that bucket will be the most volatile, especially during times like we're seeing right now early on in 2025, but you've got time to weather that storm. The bucket strategy helps you avoid selling positions at a loss during market crashes or market volatility in order to fuel your annual expenses. We don't want to lock in those losses. Let me give you an example. Let's go back to 2008, the great financial crisis. The S&P 500 dropped nearly 40% in 2008. If you had retired that year and had to sell stocks in order to fund your cash spending in retirement, you would have been selling positions at an extreme loss. By 2011, we had seen that the market had significantly rebounded, meaning you'd be able to refill your bucket 1 cash needs from stock positions that had regained their value, thus giving you the time to weather that volatility. And now when you need cash again, you can sell positions at a gain versus selling positions at a loss. Really, a balanced approach is key. You want to have some bucket 1 cash reserves. You need bucket 2 with the right mix of bond funds, a laddered bond structure, and then dividend-paying stocks or dividend-paying funds to generate some consistent income and experience less volatility. And then you still need some bucket 3 growth assets, whether those are growth exchange traded funds or just growth stocks, to help you fight inflation over the duration of your retirement life. If you want help, reach out to us. Go to our website, therealmoneypros.com, click on the Ask the Experts feature, and let us know that you need help building a retirement plan that can minimize the impact of sequence of return risk.